So, our topic today, we're going to be focused on some actionable ideas for tax shelters for business owners. We just came through 15th of April, painful day for some of you out there, and we're looking for ways to make it less painful next year. And so that's what we're going to be talking about today. So, we're going to be talking about tax shelter, ways we can shield ourselves from the storm. We're going to be talking about really three specific things today is that you can do as a business owner to reduce your federal tax liability. Now, what we're going to be talking about today is intended to be educational in nature. I'm not giving you any legal or tax advice. You want to make sure that you're consulting your tax advisor, your attorneys on this type of stuff. Go to irs.gov and go nuts reading as much as you can about these types of things. Here at Reveille, we serve a lot of business owners, and they appreciate the fact that we can integrate the planning through their business to help them in their own personal financial planning journey. We're credentialed, experienced professionals to be able to help them through those things. But let's get into these three particular items that I want to discuss. And the first one is the pass-through entity election. So the pass-through entity election was created back in 2018. It followed the Tax Cuts and Jobs Act of 2017, the first Trump tax package that went through. One of the main changes that happened as a result of that legislation is that the state and local tax deduction was capped at $10,000. So that was not good for people who live in states with high tax rates, high property taxes. Now, Big Beautiful Bill raised that number up to $40,000 starting in 2025, but it's not a permanent change. It is scheduled to sunset in 2030, and it's going to go back to $10,000. However, this $40,000 threshold, even though it's been raised there, if you are a high income earner, because the Big Beautiful Bill stipulated that once you get to the $500,000 a year earnings mark, everything over that is going to reduce your SALT cap deduction threshold by 30%. So by the time you are making $600,000, $100,000 over the $500,000 threshold, 30% of $100,000, $30,000 worth of reduction, you're back to just a $10,000 state and local tax deduction on your federal return. So for high income business owners, this PTE election is a way where they're going to be able to pay the state tax that is due for them personally as a business expense. I think there are 37, 38 different states and municipalities that have signed on to this PTE election, where that business owner is going to be able, again, to make payments directly to the state Department of Revenue, or maybe the city, and it's going to be a business line item expense, which means that you're going to be able to deduct the entire thing against what your federal tax liability would be. So I want us to look at an example here. So let's just say that you're an S Corp in the state of Georgia, and you're looking to have $2 million in income in, let's say this is 2025. So your $2 million of income, and let's just say that the state tax rate that we're using here is just over 5%, you'd have $103,800 worth of taxes due to the Georgia Department of Revenue. So not fun. Uh, if you did not elect for pass through entity payments, if you did not make a PTE election, you got to pay this 103,800 to the state of Georgia. But when you go and file your federal return, you're only going to be able to deduct 10 grand for your state and local taxes. That number, by the way, includes your property tax, that salt deduction. It includes your property taxes. My guess, and I've never seen anything to the contrary, is that you have somebody who owns a business and they've got $2 million worth of net income, as in this scenario, they own some property, believe me. And they're already paying well in excess of 10 grand for their property taxes. So your property taxes are going to completely eat up your salt deduction allowance. So that's going to make your PTE election all the more important. But let's just say, for the sake of this example, that you don't own any property, you're just renting. But so you would be able to, if you're not making a PTE election, you're only writing off 10 grand against your federally taxable income, even though you owe 103,800 to the state of Georgia. But if you do make that PTE election and you make all the 103,800 paid from your business account to the state as this PTE election, that's going to save you almost $35,000 in federal taxes. It's $93,800 more than what the SALT deduction is going to give you. Again, it's only down to $10,000 here because we're in excess of 600,000. We're presuming this is a single person here, one individual. And because we're over the $600,000 earnings threshold, that $40,000 SALT cap has been reduced back down to $10,000. And so we're going to, by virtue of making this PTE election, we're going to save almost $35,000 worth of federal tax liability. So if this is the simplest thing that you can do as a business owner to reduce your federally taxable income. If you're not doing this, then you are incurring double taxation because the state is taxing you, and the state's taxing you, and you're paying this 103,800. But then the federal government's going to tax you on this other $93,800 that you don't have. You gave it to the state, but they're still saying, no, you owe me 37% of that number. You're like, yeah, but I paid it to the state. Doesn't matter. So PTE election can help you avoid double taxation. Very simple thing that you should be doing with your accountant. So if you're not doing it, get on it. Okay. The next piece here is Section 199A. So these first two things are just accounting oriented concepts. And I find a lot of folks, they don't take advantage of these things. They aren't super simple, but they're not that complicated. This is what you pay your CPA for, to be able to give you some advice and guidance around this. Now, as a financial advisor, the CPAs appreciate the fact that we understand these types of things. We as business owners are trying to take advantage of these things. Now, Section 199A was originally introduced by that same Tax Cuts and Jobs Act of 2017, and it was written into the tax code to try to provide a similar level of tax relief to the pass-through entity owners, so partnerships, S-corps, LLCs, as what the C corps got in that legislation. So the C corporations in the Tax Cuts and Jobs Act saw their tax rates go down to 21%. And so the Section 199A was meant to provide some level of equivalency there. However, it requires some machinations to be able to take advantage of it. It's not just a straight reduction in the effective tax rate. You have to do things to be able to make this happen. But here's what the rule says. It's going to allow you to deduct the lesser of 50% of W-2 wages or 20% of income from your federally taxable wage, from your federally taxable income. But ultimately, what we want to do is triangulate and have those numbers approximate each other. We want them to be the same number. That way, we're not leaving a deduction on the table. So here's the biggest issue. For most business owners, historically, they've always either been told or the strategy has been, I'm going to pay myself the lowest W-2 wage that I possibly can because I'm trying to reduce the amount of FICA taxes that I have to pay, the payroll taxes. And I'll just take the rest as a K1 distribution. Now, a K1 distribution still federally taxable. You're still going to owe Medicare on that, but you're not going to have the payroll taxes on the K1 amount. Well, the problem is operating with that same mindset. Let's call that a pre-2018 mindset. That's the way that you would have wanted to do it intelligently to try to save yourself some level of taxes. And it would have been small, de minimis ultimately, comparatively. But since the tax law has changed, that strategy of keeping your W-2 low, it's actually costing you a lot in terms of what deductions you have the ability to take advantage of. So I want to look at this example. We've got a hypothetical business owner, Alan, that owns ABC Metal Fabrication Company, $4 million in annual revenue. So Alan's doing pretty well. He's a hardworking man, but he is getting paid pretty well. 6 full-time employees, including himself. So this, again, hypothetical scenario that I fabricated here, $4 million in revenue. He's got $1 million in cost of goods sold. So the gross profit of his business is $3 million. $200,000 of operating expenses, $600,000 of wages, which includes himself. We'll see in a subsequent illustration. He's paying himself $120,000 salary here, but $600,000 in total wages for his company. And so he's got net income of $2.2 million that he is going to K1 to himself. Well, the qualified business income deduction, which is what Section 199A is, the lesser of 50% of wages or 20% of income. So we've got wages of $600,000. 50% of that is a $300,000 QBI deduction, which is great, but it's not 440. It's not 20% of income. So we've left a pretty meaningful deduction on the table there for Alan. That's where he's just proceeding forward with maybe the way he's always done things. I'm trying to pay myself somewhat of a reasonable wage. If the IRS ever asks, I'm going to argue with them why this wage base for myself as the business owner is reasonable. And maybe I have an answer for that. But that same mindset, it's costing him a pretty significant amount of Section 199A deduction. So what do we do? What does Alan do? Well, his CPA is going to tell him there's a way that you can solve for an optimal wage base. Because again, our objective here with Section 199A is to try to find a way to have the 20% of wages or 50%, or I'm sorry, the 50% of wages or 20% of income match each other. And so there's a formula where you can take 2/7 of income excluding salaries and you back into what this optimal wage base is. So we go back to, we've got 2.2 million in net income. Let's add the salaries of 600 grand back in. Income excluding salaries is 2.8 million. We're going to multiply that by 2/7, which is that 0.2857 number. So it's almost $800,000 worth of wages that we need to have. And so we're paying 600,000 right now. So what Alan needs to do is pay bonuses of almost $200,000, presumably to himself. Okay. So the adjusted income for his business is going to be just over $2 million. But what happens there when we do that? Again, we've got QBI is lesser of 50% of wages, 20% of income. Those numbers now are effectively the same. They're both 400,000. So this is not investment advice whatsoever, but just part of our role as an advisor in working with the business owner and their CPA is to try to find we're trying to help you maximize your level of tax, your maximum level of tax deduction. PTE election, number one. Number two, Section 199A. As long as you are not a specialized trade or business, specialty trade business, then Section 199A is for you. So in this scenario, Alan's gone from having a $300,000 Section 199A deduction to almost $400,000, and all we had to do is get his wage base aligned where it's supposed to be. Now, what he could say is, yeah, but I have to pay more in FICA taxes if I increase my W-2 by almost $200,000. He is correct. However, the taxable wage base, Social Security wages, and I'll have to check and see what the number is now in 2026. It was $176,000 in 2025, I believe. And so if he's already paying himself $120,000 and he's paying FICA taxes up to that amount, even if he bonuses himself almost $200,000, he's only going to pay FICA taxes up to that Social Security wage base. So in this particular instance, maybe another $56,000. He's going to pay 7.5%. On that, he's going to pay $4,200 more in FICA taxes and payroll taxes, but he's going to get a $100,000 larger Section 199A deduction. Still sounds like the math is working out for you. You may pay a little more over here, but you're going to get a much larger deduction over here. Take advantage of it where you can. All right, let's keep moving here. What is that ultimately going to translate to? So I want to look very quickly at a couple of retirement plan illustrations where if we were trying to show Alan, all right, you still have a tax problem, right? Because you still have $2 million worth of net income, right? We still have adjusted income of $2 million that you're going to get a K-1 for. So we got to try to help you out. What can we do? Well, we need to make sure that you have retirement plans established that's going to allow you to shelter as much as possible. And as a business owner, you have a lot of flexibility in terms of what this plan design is. And we want to try to help you find a way to create a plan design that allows you to shelter as much as possible for yourself, take care of your key employees that you want to provide for, that perhaps you want to have some golden handcuff around. So there's some vesting schedules associated with some of these things like profit sharing plans, cash balance plans, where if the participants don't stay for a certain period of time, they're going to forfeit some or all of that benefit that you have put in there for them. And I feel like it's maybe not happening as much right now in 2026 as we saw in the few years after COVID. You don't have as many people changing jobs today that you did 3, 4 years ago. 3, 4 years ago, they were leaving to work at a competitor and they were going to make another 15 to 20% more than what they were making somewhere else or in their current job. And so you had a lot of job changers going on. That is not so much the case again now, but a lot of businesses are trying to say, how can I find a way to keep my workforce here? And so these are the golden handcuffs that you can use with the retirement plans that have these vesting schedules to give people a reason to doubt that they should leave. So, anyhow, the plans that we could look at for somebody like Alan, he may already have a 401k, but 401k really table stakes. You've got $24,500 worth of annual salary deferrals that can go in there if you are 50 or less. There are catch-up contributions available for those that are over 50. So another $8,000 from 50 to 60. There's another super catch-up for 60 to 63 of $11,250. Then it goes back to $8,000. Profit sharing alone, or the combination of these defined contribution plans, allow up to $72,000 a year worth of contribution. That's for 50 or less. If you're over 50, can go up to $80,000. And stacking on a cash balance plan, again, this is a company contribution as well, but this is where you have the ability to set aside a substantial amount of money, reducing your current tax liability. So if you are in your peak earnings years, and so we do a lot of these cash balance plans, but the first thing that you want to think of when you're talking about cash balance plans is peak earnings years. So if you are in your 50s, you're probably in your peak earnings years as a business owner, maybe early 60s. That is when you are going to get the most bang for your buck with a cash balance plan. If you are a super successful business owner and you are 35 to 45, you may be a little early on the cash balance plan to take full advantage. Still better maybe than not doing one, period, if you are desperate for the tax deferral immediately. But when you're going to take advantage of it the most is when you are a little older and in your peak earnings years. So again, here we are with Alan. He was paying himself $120,000 as a W-2. So even if he wasn't increasing his salary whatsoever, say he wasn't really trying to maximize the Section 199A, what could he be doing from a tax shelter standpoint if he were to have a 401k with maybe some matching provisions, adding a profit share in a cash balance? Well, what we see is that at this $120,000 income level, because he's over 50, he could put in $30,500 into his 401k. We don't have any company contributions going into the 401k for him in this particular illustration, but he's going to max out over on the profit sharing side. And so this number right here for 2026, by the way, would be $32,500. So this illustration is for last year. But he would max out on the profit sharing side, and then he could add in a cash balance plan, put another $120,000 aside for himself. And so for Alan, he's going to be able to shelter $196,500 for himself if he doesn't increase his wages at all. Now, he's going to have to put some money in for his staff to be able to do that. So the IRS is not just going to allow business owners to shelter as much as they want and not do anything for the staff, but you try to find ways to be able to reduce the staff cost. There are permitted disparities that are allowed. But in this particular example, we've got $222,000 worth of company contributions, right? So that's not salary deferral. It's money that Alan would be putting in from the business side, $222,550. Of all of the contributions that would go into this plan, Alan's getting almost 78% of it, right? He's our key participant. That's pretty good. That's pretty good demographics, right? The big thing here is his total projected income tax savings at a 40% tax rate. And so again, we're talking about somebody in the top tax brackets. This could probably be even a little more between federal and state taxes. But adopting this plan is going to save him over $100,000 a year in federal tax payments due. Now, the numbers can get even a little better, right? Because remember, right, we got to go back, we got to take these retirement plan contributions, we got to integrate that back into his books. So we've got 2.2 million in net income. Those company contributions that we talked about, $222,550, are ultimately going to reduce the income or the profitability of the company, which is the objective here. We're trying to take money off the top line that's going to get taxed. And so we're going to find that ultimately the optimal wages for his business, it's not almost 800,000, right? It's closer to 735. Okay. So he needs to bonus out, another $136,000 or so. So his qualified business income deduction is ultimately going to be right around 368 or so. Okay. Because these numbers are practically the same. But now that we're seeing that his income needs to go up by 136,000. So let's go and say, all right, what if we're going to move it up just to 240 from 120? So we're going to take it up by 120,000. What does that do for his tax shelter capabilities? Well, we've gone from 196,000 to $316,500. But this is the real kicker, right? Well, we're just trying to keep it simple. There's always a pie chart, right? I like to look at the pie chart. And I tell my business owners that we're working with, whether you're adopting these tax sheltered retirement solutions or not, there is a pie chart out there for you. But instead of saying key participants and other participants, it says your name and state or federal government over here. And the slice of the pie that they take is considerably larger than this. So you have the ability in this particular scenario, once Alan takes his W-2 wage higher, it's going to further increase the amount of tax shelter that he can take advantage of through these retirement plans. You've got two real levers that you can pull from a demographic standpoint to make these retirement plans more favorable for your target group. You're permitted to discriminate using two different factors. The first one is wages. The second is age. So ages and wages. If both of them line up, then you've got a very powerful scenario here. So in this particular example, right, Alan is 60 years old. And so he's the oldest of his team, right? The next oldest person who works there in this scenario is 51 years old, is an office admin that he's paying $50,000, right? But he had a machinist that was 12 years his junior that he was paying more than himself. Remember, he was paying himself $120,000. He was paying this person, who's really his right-hand man, was paying them $150,000. But in order to really have this plan skew to favor himself, Alan has got to take his wage up over and above that other person that he was formerly paying more than himself. And so once he does that, we go from him receiving 78% of all of these contributions to over 86. And this is a slam dunk. If we ever see a scenario like this for a business owner, you're going with that all day long. All day long. Projected tax savings at a 40% tax rate in this scenario was almost $147,000 that you're not paying to Uncle Sam or the state. That's a lot. And so again, imagine in these scenarios, right, versus where we started, okay? So he's going to end up in this scenario once he maxes out the retirement plan contributions that he can make, and he has gotten the largest Section 199A deduction possible. His QBI deduction is going to come to just under $350,000. So if we were to say, look, you started in a scenario where you were paying $600,000 worth of total wages. You had $2.2 million worth of net income. You had a $300,000 Section 199A deduction. And again, this is better than nothing, okay? But what we're trying to do is find a way where we're helping you optimize what your wage level should be to try to get you the largest Section 199A qualified business income deduction possible. And then how can we help you maximize the level of tax shelter that you're getting in conjunction based on that wage that you're paying yourself. And so in this scenario, Alan's going from, he's got a $50,000 almost larger Section 199A deduction. He's got a $280,000 greater retirement plan contribution. He is going to pay a little more in FICA tax, but ultimately his K1 that he's going to get is down from his original scenario. It's down $450,000. So he's saving a lot of money in taxes as a result of taking advantage of Section 199A. One thing we don't even have worked into this particular scenario that would further benefit him is we don't have PTE on the list. We don't have PTE on the list. If we did, it's getting even better for him. Okay. So just understand that the three things that you want to be taking advantage of here as a business owner is you want to be doing the PTE election. You want to be doing Section 199A. And then also you want to make sure that you're integrating that into your retirement plan design, that you're going to take that higher wage base that you're going to pick up as a result of doing your Section 199A, and you're going to use that to increase what the government's going to allow you to shelter in these retirement plans. So, all right. Thank you, everybody, for joining us here on this latest installment of the $1 Million Question. So a lot of, dense material for today. There are ways that you can save money from, on your taxes. Now, the government doesn't make it super simple. I wish that they did, but they do it this way to try to discourage people from even going forward with it. But I'm telling you, it doesn't have to be that complicated. PTE, something you should be doing very simply. The Section 199A, it requires some triangulation. But if you're not doing that right now, you need to be asking your CPA, how do we arrive at my optimal wage number for my company so I can maximize Section 199A? And then if you are in your peak earnings years, how much tax shelter am I leaving on the table? That's what you need to be asking yourself. That's what you need to be working on with your financial advisor. If you want us to run an illustration for you, send us an email. We'll be happy to do it. We'll connect you with some of our TPA partners that we work with, shoot us an email, info@reveillewealth.com. These are things that you should be contemplating. All right. But these are the three secrets: PTE, Section 199A, and then using these tax sheltered retirement plans to reduce the amount of money that you're having to send in on April 15th. We want to try to make April 15th just another day on the calendar. It's still going to sting. So taxes is the cost of success in this country. We want to try to find a way to keep as much of that success for the business owner as possible. And these are some of the three ways that we can help you do it. But we appreciate you for joining us here. And we will look forward to seeing you next Thursday, 10 a.m. here on Stock Market TV. Have a great weekend. See you next time.